Hello and welcome to Macrobytes, the economics and politics podcast from Aberdeen. My name is Paul Diggle.
And I'm Luke Bartholomew.
And while Macrobytes has been off on its summer holidays, it's been a cruel summer in financial markets. A weak US jobs report meant investors started to worry about the risk of a US recession and now think the Federal Reserve will have to cut rates pretty quickly and substantially. And a larger than expected rate hike by the Bank of Japan caused a rapid unwind of the so-called yen carry trade, seeing the biggest one-day sell-off in Japanese equities since the crash of the late 1980s. So this week, we are going to ask whether the US Fed is behind the curve and has left it too late to cut interest rates, and whether, by contrast, the Bank of Japan is too far ahead of the curve and is hiking rates at just the wrong moment. So we're delighted to be joined in this conversation by James McCann and Sree Kochugovindan, economists here at Aberdeen. Welcome, James. Welcome, Sree.
Thank you for having me.
Thank you, Paul.
So, James, let's start then by talking about the US and the Fed and the triggering of the SARM rule, which occurred in the July labour market report, was a key inflection point in financial markets and how investors were thinking about the US economic cycle. Tell us quickly what the SARM rule is and how worried it should or shouldn't make us about the risk of a US recession.
Yes, well, starting from the beginning, the SARM rule was developed by a Fed economist called Claudia Sahm, the clue in the name there, as an early warning signal as to whether the US was going into recession or not. And I think the intention was to use this as almost an automatic stabilizer, that this very reliable and early sign of a downturn could then be used to trigger some sort of fiscal stimulus to try and mitigate that downturn. Essentially, it's based on an empirical regularity that once the US unemployment rate rises by a certain amount, that's often a very, very clear signal that you're heading into a downturn, or in fact in the early stages of a downturn. And what Claudia Sahm did was work out the exact threshold by which this predictor was most reliable, and found that when smoothing, an increase of 0.5 percentage points almost always tells you you're in the early stages of a recession. And of course, this is important as you highlight there, Paul, the last Labour report showed an increase in the unemployment rate in the US to 4.3% and meant that increase in unemployment over the preceding low point from the past 12 months is now a tiny bit above 0.5 percentage points. So, from a historical standpoint, we should be really worried because this has been an incredibly reliable indicator that the US is going into a downturn / in a downturn. I do think, consistent with a number of features of this very unusual business cycle, there are reasons to think that this time could be different. Certainly we're seeing
the four most dangerous words in economics.
I know, and it makes me extremely nervous reaching for those words, to be honest with you. But thinking about the reasons why this time could be different, and as part of that, we should remember that the SARM rule, despite its name, isn't a rule; it's an empirical regularity. But the reasons it might be different, one, is that we've had unusually strong labour supply growth as we've recovered from the pandemic and participation rates have been rising. In fact, the increase in unemployment in July was driven more by rising participation as opposed to softness in employment, which actually increased over the month. And we've also had immigration flows as well, which have added some fuel to that fire. So you could make an argument that part of the weakening in the labour market this time is more benign, in that it's more of a supply issue of labour rather than a demand issue. So that's one reason. One could be measurement. And again, it comes around to this issue around immigration. The household survey is struggling to capture the very significant flows of immigration over recent years, particularly over the southern border of the United States. That's estimated around 3 million people a year coming into the US economy. Not all of those will be of working age, of course, but it's possible that that's adding some distortions or grayness to the data and not being fully captured. And the third is around balance sheets. We know that household balance sheets have been unusually strong this cycle. It's meant that they've been perhaps more resistant to some of the shocks to real income growth. They've been more resistant to some of the high interest rates, so that could provide additional ballast. It's not impossible that this cycle, the SARM rule, should be a little higher. So it would take an increase in unemployment rate of a larger magnitude to tell us really that this economy was ending. The way I'm trying to bring all this together and interpret it is that it's clear evidence that the economy is weakening. So clear evidence of a slowdown setting in. Don't yet think we should be breaking that emergency glass yet and signaling that the economy's in a recession or downturn. But certainly, it should put us on high alert, especially as you say, given the precarious feeling nature of arguing that this time is different.
And it's worth saying that a lot of these classic recession rules, triggers, signals haven't worked this time around. This cycle has been different so far. The yield curve signal, inverted yield curve, leading economic indicators, the senior loan officer survey, they've been different this time. So, while it's always dangerous to say this time is different, it has been so far.
That's right. And part of this relates to the type of business cycle that we've been in, which has been a pandemic affected one. So that enormous dislocation in the economy during the pandemic, the extraordinary policy responses that we saw, both monetary and particularly fiscal, which seems to have had a long echo into the economy, particularly given the effect that that's had on balance sheets in the household and corporate sectors. So these are forces that have maybe upended some of that regular calculus we've done and upended some of those more traditional rules. And that's why many economists this time, last year or in recent years, had been calling for a recession, because some of those classic indicators were flashing red and the weight of history was on its side. I think, one thing that this cycle has taught us is that they're not always fail-safe indicators in themselves. So, I think there is information there, absolutely. And I think it's a concerning signal. I think it's the one the Fed needs to take seriously. But I don't think it's one when we look across the totality of data too and try and cross-check this with other, business cycle indicators, we should be calling a recession at the time being.
So something I sometimes worry about is whether we're being a bit reductive in framing this debate in terms of recession, yes or no. I mean, after all, the Fed is tasked with the rather more demanding job of full employment, not just avoiding a recession. And so while being very clear, as you were there, James, about the reasons why unemployment is rising this time is extremely important for thinking about those recession risks and thinking about whether the SARM rule will apply this time or not. Perhaps in the context of the dual mandate, it's slightly less important. It's less about why unemployment is increasing and more about, is it increasing at a level that's above something that we might consider full employment? What are the welfare consequences of this rise in unemployment? How to think about that trade-off with the other side of the mandate around inflation. And I suppose the very reason that the Fed can be thinking about these kind of questions around unemployment and recession is precisely because that other side of the mandate has come good recently, in the sense that the sequential rate of inflation after a rather scary bump higher in the first quarter of this year has now seemingly come back to something that is more target consistent. So I'm wondering, do we have a good understanding of why there has been that quick reversal around the inflation scare in Q1, and what might that tell us about the path of inflation going forward?
Yeah, I think it's worth putting into context some of the to's and fro's in inflation over the last 12 to 18 months to start. If we think about the second half of last year, this was the period of the immaculate disinflation in the US, where inflation was really surprisingly well behaved. If I look at core PCE, probably the best indicator, the Fed's preferred indicator, I think, of underlying core inflation, that was running at a 1.9% annualized pace, pretty much spot on the Fed's target. At the start of this year, that more than doubled. So the first 3 months of 2024, that run rate increased to 4.5% annualized. And then since in the 4 months after, we don't actually have the July reading for core PCE, but we can impute it based on what we've had from CPI and PPI. And over that 4 month period, inflation is back down to 2.1%. So it gives you this sense of this sort of seesaw motion in inflation. And very much it's making that Q1 surge look like more of an anomaly as opposed to something more alarming, like a reacceleration in underlying inflation. Explaining that is challenging. I think there are a few candidates. One is residual seasonality, particularly around price resets at the start of the year. Now, of course, statistical agencies in their seasonal adjustment try to capture this typical seasonal pattern, but it's possible that, after a large inflation shocks and with differences around post-pandemic pricing patterns, that some of that adjustment hasn't been able to fully offset what we're seeing in terms of those seasonal patterns of price resets, especially in the services sector, where there's a degree of catch-up and laggingness in some of those price adjustments. When we looked at the data, certainly there were one or two components in that Q1 spike, which just looked a little idiosyncratic or odd. In core goods, there was software equipment, a very small component playing an outsized role. That's normalized a little bit since. We know that portfolio management fees were being boosted by very strong market performance. That's cooled off a little since as well. So I think there were a few idiosyncratic things going on. And then finally, maybe more fundamentally, the economy has probably been stepping down a gear over that period too. And maybe that explains less of the second half of last year versus Q1 this year, but maybe more of the recent softness in pricing dynamics could reflect, that softening in the labor market that we are starting to see, and that step down in headline growth. Some of the weakness we've seen in core goods has been related to autos, which, again, I think that's a roll off of some of the pandemic factors that affected supply chains there. But it's been more broadly based across durable goods too, and I think that reflects some loss of pricing power. So, I think there's some maybe temporary factors that push Q1 up. I think there's some fundamental factors which are pointing to an ongoing slowdown. But I think the good news is that spike looks more of a bump than a shift in trend, and the underlying trajectory looks more encouraging, I think.
I mean, perhaps for the sake of completeness, and because we're economists and it's always our job to point to risks, it seems as economists it might be worth saying that, of course, there are still some residual risks around the inflation outlook. As you say, there's been this seesaw. We don't always entirely understand the data generating process, and it's possible we just get another scary bump higher. Perhaps that's around seasonal adjustment factors or something like that. And then more fundamentally, maybe an energy price spike, or I think it's relatively uncontroversial to argue that aspects of Trump's agenda are in some ways quite inflationary, and it's possible that as and when the market perhaps begins to focus on that again, that inflation concerns pick up. And the reason it's worth stressing that is because it does feel that the current setup is such that concerns around stagflation, or as we used to call it, no landing, or just simple, inflation picking up concerns are probably the pain trade for the market right now, as it gives this perception that maybe it's going to be harder for the Fed to deliver the kind of cuts that are necessary for a soft landing. And I guess in that sense of delivering a soft landing, there is a pretty crucial distinction around the kind of cuts that the Fed can deliver between this idea of proactive rate cuts and reactive rate cuts. And I guess with proactive, what we have in mind is that the Fed is easing in anticipation of future weakness to try and stop it or to deliver the soft landing. And in the case of reactive, it's because the economy has already got weak, and thus policy needs to become more supportive for that reason. And why that distinction is so important is because, well, A, it has bearings for whether we will get a soft landing or not, but also B, the correlation structure between bonds and equities probably depends on whether these are perceived as proactive or reactive cuts. I mean, perhaps bonds do well in both cases. Interest rates are coming down, but maybe it requires the perception of proactive cuts for that to be equity market supportive. So, I mean, what do you think the Fed needs to do, both in terms of its policy itself and the signaling around it, to make sure it's seen as being on the right side of that important distinction?
Well, I think as the evidence becomes more and more clear, the policy is tight and is restrictive, and that might seem more obvious now, but I think there have been, really, really good debates around the degree to which policy was tight as recently as 3 to 6 months ago, when things like a no landing were looking like a very credible risk in the US economy. So as it becomes clear that policy is tight, as the Fed, in fairness, has been arguing, and the risks around the Fed's mandate, you mentioned that earlier, Luke, that dual mandate of inflation and growth are becoming much more balanced, and it becomes appropriate to start dialing back that restrictiveness And that becomes a critical component of the soft landing. That sense of proactive versus reactive, I think, was played out in markets. When we saw markets at the peak of their panic, they were pricing in a lot of Fed cuts, but obviously that wasn't especially supportive of equity markets. We had 150 basis points almost priced by the end of this year, but that was a point at which the equity market sell-off was at its peak. Since then, the market's maybe seen a few broader data points and become a little bit less concerned around the near-term recession risk, or perhaps taken some comfort from those data. And I think the pricing is quite interesting now. It's around 4 cuts over the course of this year, but obviously that's been associated with a market which has rebounded quite rapidly. So I think that gives the sense of a Fed which is still expected to ease in a more aggressive way, but one that is seen in enabling and supporting that soft landing. And while I don't think the Fed necessarily needs to deliver exactly what's in the market price, I do think it needs to move, more rapidly towards neutral policy settings. So, my expectation is they'd probably cut at every meeting this year, at each of the 3 remaining meetings. I think they'll move in 25 basis point increments. I think should we see further alarms coming from the labor market or more broadly, they can step that up to 50 basis points. But I think what's really critical is that sense that they're dialing back policy. They're doing so at a relatively proactive and aggressive rate. And critically, they're very responsive to signs of weakness. And if this dynamic, as you mentioned, Luke, between softer inflation gives them the room to do that, that's very helpful. Agree. If they were to get nasty inflation surprises, then that balancing act becomes more challenging.
And it's worth saying, James, that we're talking just before the start of the Fed's Jackson Hole Symposium, this major monetary policy gathering at which Chair Powell is going to be given a much-watched speech where he's going to have to tread this fine line between reassuring the market that they're ready to start cutting rates, that they're responsive, that they're still trying to achieve the coveted soft landing, but then not perhaps scaring the horses by reintroducing the idea of emergency cuts, bigger cuts. So a really tough balancing act he has there. But Sree, why don't we talk about Japan and the BOJ? Because that's been the other key part of recent market developments. The Bank of Japan is in a very different place to the rest of the world. It's tightening, whereas just about everywhere else is easing or about to ease. So whereas the Fed debate that James has been talking about is all about how much they're going to ease, in Japan it's actually about how much more are they going to hike. Why don't we start, though, by talking about why the Bank of Japan is in such a different place in this cycle to the rest of the world?
Yes, it is. There's a big divergence between trends in Japan and the rest of the world, as you say. And this is really there's a long history there of Japan experiencing decades of either deflation or low inflation. So this really has set aside the monetary policy settings as well. So we've had decades of slightly negative interest rates. We've had yield curve control as well, very unconventional, ultra easy monetary policy. Now, since the pandemic, obviously there's been a shift here. We've had some, given the supply chain shortages and imported commodity prices and fuel prices, there's been a surge in inflation, even in Japan. Relative to other countries, the peak is obviously very low. We're looking at 4 or 5% rather than the double digits in other countries. However, it is a turning point for Japan, and there is some optimism that Japan can enter a new inflationary regime. So the dilemma really for the Bank of Japan is whether or not this is sustainable inflation, and that's the question that investors are really facing at the moment.
And we've spoken previously about both the macro reasons that the Bank of Japan might have to hike rates, as you're saying, the emergence from disinflation, strong Shunto wage rounds, but also market reasons, because obviously until very recently there was this enormous downward pressure on the currency, on the yen, as Japanese rates were so much lower than those in the rest of the world, especially the US. But when the Bank of Japan has actually come to do the tightening, it's also had big market repercussions, and especially that late July larger than expected rate hike, which caused this unwind of the yen carry trade. So, tell us a bit about what the yen carry trade is, and then how should the Bank of Japan think about that experience of severe market stress when it did start hiking in terms of what it does next with monetary policy?
Yes, so a bit of context is needed there, I think. As you say, the yen carry trade has been quite critical in this recent market sell-off. The divergence in interest rates, particularly between Japan, whether it's government bonds, JGB yields, and the Fed, the US yields as well, that divergence has been quite wide. And that's really encouraged investors to sell the yen on speculation. So a lot of the move this year has been quite speculative within FX markets. So what investors can do is use the yen as a funding currency. So you borrow at negative or zero rates from Japan, and you can use that to invest in US assets. And we've seen the rally in US equities, particularly the MAG 7 and other risk assets as well. So this yen carry trade there's been a bit of concern about that building in recent months. What happens when yields actually shift and this carry trade starts to unwind? So it's something we've been looking at, and the expectation, and the Bank of Japan is aware of this, but the expectation is that they will move with caution because they are aware that they do not want to distort markets. However, what we've seen in recent months and weeks is that there was an increase in speculation which pushed the yen quite rapidly from around 150 level to 161. Now, just to take a step back, last year everyone was concerned that the yen was very weak at 130 to the dollar. So 161 was incredibly stretched, and you can see that positioning was extraordinarily short at that time, shorting the yen versus the dollar. And there was a perfect storm during that time. So the Bank of Japan hiked more than expected. And they also announced a very cautious QT program as well, where they start pulling back from their purchases of Japanese government bonds. That was at a very slow pace and in line with expectations. But there was a combination of the BOJ, but also the Fed signaling they would ease. And there was US payrolls, which was weaker than expected. And really, you need to think of this as two legs. There's the Japan story, but also expectations around US easing as well. So it's really that combination of the two moving that led to a trigger in markets, and some of these shorts started to unwind. You can see positions really being flushed out very, very rapidly, like a knife falling, and that was really the backdrop for that particular week.
The Bank of Japan came in very quickly afterwards then and sort of played down the extent of its hawkishness.
Yes.
Are they going to be hiking further, and how should they think about treading carefully in terms of market fallout from here?
Yes, I think the BOJ communication has always been quite challenging over the last year in terms of how investors perceive the Japanese wording of their outlook for policy. First of all, during the Bank of Japan meeting, the policy meeting, they were extremely hawkish. That was the first thing. They had to walk that back, as you say. But now markets have stabilized a bit. A lot of those short positions have been flushed out. We're still in August. It's still holiday thin markets, so they're not out of the woods there. There's some of the liquidity measures are quite weak. So some of those technicalities are still in play. Now, it will be very interesting to see on Friday, Governor Ueda is scheduled to speak at the Diet in front of politicians. I think communication there will be quite challenging against this backdrop of, holiday thin markets. So really going forward, the fundamentals haven't changed. Any policy decision will be dependent on market volatility, and that is something they've stated. While markets are volatile, they will not be moving policy. But the fundamentals, as I say, are still there for a rate hike going forward. Their path, what they had signalled over the last year, has been for a gradual removal of this ultra-easy monetary policy. Now, interestingly, just earlier this morning, the Economics Department of the Bank of Japan published 2 papers discussing exactly this. The fundamentals are still there. They're talking about wage growth, they're talking about service sector, shortages in the labour market. All of these are really focused on domestically generated inflation pressures. Those drivers are still there, and they are watching very closely the change in corporate price setting behaviour. So all of this is signalling, particularly the timing of this paper being released just before Governor Ueda is due to speak. I think this is signalling that, again, depending on fundamentals, if the market is stable, they have a case to hike in October. I actually think that they'll go at least 10 basis points in October, and then very cautiously from there on. So even though there was a shift in expectations around BOJ interest rates by the market. I think that if the market stabilizes from here, we could see another hike in October.
It's very interesting the way you set up the Bank of Japan's thinking there, Sree, because it almost feels to me like there might be a bit of a 180 compared to the thinking around Bank of Japan policy, say, over the last 18 months or so, where perhaps the argument went that, look, there are some macroeconomic reasons for tightening, but they're not that compelling. Perhaps more importantly are the market factors, the need to support the yen, perhaps to do something about JGB functioning, maybe there are financial stability risks.
Yes.
And now it feels like actually the macroeconomics make a slightly more compelling case to start tightening further, given what's going on around underlying inflation, but it's market considerations that would stay the hand a little bit. Those same financial stability concerns maybe weigh in the opposite direction now. So I'm wondering, first of all, whether you sort of agree with that sort of framing, whether there's been this 180 switch around. And then I don't know whether this is related or not, but of course the Japanese Prime Minister has recently announced he's stepping down, Kishida, and there were all sorts of domestic reasons around this, scandals. But it seems that one of the issues is related to unpopularity from higher inflation and a weak yen. So there's an argument that goes, perhaps the new government, as and when it's formed, the new Prime Minister will be keen to pressure the Bank of Japan to avoid another period of yen weakness. So do you think that's also going to weigh on the Bank of Japan's thinking as well?
I think there's some really interesting points there. So first of all, to take the first question, in terms of fundamentals, if we take a step back, the key problem here is domestically generated inflation. That's what they really need to focus on. So what's happening there is that we've had a very strong wage negotiation, or Shunto spring negotiation round, historically strong. That's very good news. However, we haven't really seen that feed into realized earnings in a material way. Earnings are starting to pick up, and the key is base pay. So you can see a lot of fluctuations in bonus payments. That's been very strong recently. But it's the base pay that needs to pick up. And there are signs of it improving, but it's still looking at 2.5%. You need further feed through from wage negotiations. There is a narrow window of opportunity for the Bank of Japan, which is why I say October. And there's a few things there, political as well as data, that are important for the Bank of Japan. So there is a downtrend in various inflation measures. And I think if they don't go soon, there will be a risk that they won't be able to actually normalize policy. So there, as you say, there's the macro. There is some signs of inflation, but they're still a bit weak, in my view. And then the second would be the market distortions. The fact that there is such a wide differential between Japan and other countries, particularly the US, is detrimental for the Japanese economy. Stability in currency is very important. Not so much the level, but stability. So if you have these wild speculative moves, that's not good for corporates. They can't really plan ahead in terms of pricing, investment, and so on. So the stability there angle is just as important, and it remains so. Yes, the drivers have switched, that the rationale has switched, but it's still financial market stability, and inflation needs to be moving in the right direction. And if we just to think, it's still only 25 basis points at the moment. It's very, very low. It's still close to zero. They have a long way to go in terms of normalizing, and it's going to be a very cautious path. Consumer spending has, in the last quarter, has picked up finally after 4 consecutive negative quarters. There's a rebound there in consumer spending. So this mentality around inflation needs to shift. Consumers need to be able to accept higher prices rather than pull back spending. And corporates need to have faith that they can pass on input costs. So this is a key dynamic there. Now, the second part of your question was about politics. And yes, the Prime Minister has stepped down. Now, in terms of the next steps, we have to say that, we had a decade or so, 14 years of stability with Prime Minister Abe. Prior to that, there was what you call the revolving door of prime ministers. We seem to be again in a very high-frequency leadership change era, back to the revolving door. So we're looking at the third prime minister since Abe resigned. Now, the leadership contest was scheduled for September, so the fact that he stepped down didn't really impact markets that much. It was broadly expected given the unpopularity. The next leadership contest will be the 27th of September. There are 11 potential candidates. There's no strong front runner just yet, but the bottom line is that the broad policy path is unlikely to change under the LDP as they remain the ruling party. The second point is that the LDP, they have been the ruling party for many decades. There's very little in the way of a serious opposition that can really change that dynamic. So we're expecting the LDP to remain the ruling party, even if there is a snap election, which is a risk. And that is a risk that could affect timing of the next rate hike if there's a snap election this year. The lower house term ends next year. I think it's October next year. So there has to be election announced before that. So within a year of the new Prime Minister coming in, there'll be another a general election. But bottom line is that there's unlikely to be a major policy change. It will be business friendly, market friendly. Now, there is one candidate that is a potential wild card, and this is Sanae Takaichi. And she prefers to maintain large-scale monetary policy. And she is more aggressive in terms of the fiscal stance. It could be more aggressive than Abenomics. So she's one to watch. Again, there's no front runner just yet, but there is a potential risk, a small risk, that the original agreement or joint statement between the Bank of Japan and the government, which was set back in 2013, and it set the inflation target at 2%, there is a risk that what if the new leader comes in and rips that up or changes it in some way? That would be a material shift for the Bank of Japan. But overall, it doesn't seem that really the politics are going to have a big impact on Bank of Japan policy. And really, it's going to be a case of mainly what happens with the Fed and US data. So that's really been a key driver of currency and equity markets in Japan recently. So more the US rather than domestic politics, if I'm honest.
All right, well, I think that is all we have time for this week then. So as ever, please do let me ask you to review and subscribe wherever it is that you like to get your podcast. And then all that remains is for me to thank Sree and James for joining us today for their excellent conversation, and to thank you all for listening. So thanks very much, and speak again soon.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment, recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.